The U.S. financial system is the beating heart of the global economy. It's a complex network of banks, markets, and institutions that keep money flowing around the world. But what happens when that heart falters? A U.S. financial collapse would send shockwaves across the globe, with consequences both immediate and far-reaching. Jobs would vanish, businesses would crumble, and entire economies could teeter on the brink. While it's a grim scenario to contemplate, understanding the potential risks is crucial for safeguarding our interconnected financial future. The US dollar reigns supreme as the world's reserve currency. This means that other countries hold large reserves of US dollars, using them for international trade and investments. A collapse in the US financial system would devalue the dollar, eroding the wealth of nations and businesses holding dollar-denominated assets. This could trigger a cascade of currency crises around the world as investors lose confidence and scramble for safer havens. The global trade system, heavily reliant on the US as both a consumer and producer, would grind to a halt. The US imports goods and services from every corner of the world, and its exports are a vital lifeline for many economies. A financial collapse would cripple US consumer demand and disrupt supply chains, throwing the global trade system into disarray. Countries heavily dependent on trade with the US would face severe economic hardship. Imagine a world where trade routes turn into battlegrounds and economic cooperation gives way to protectionism. This is the dangerous path that trade wars carve, and when combined with a US financial collapse, the consequences could be catastrophic. Trade wars, characterized by tit-for-tat tariffs and escalating tensions, disrupt global supply chains, increase prices for consumers, and stifle economic growth. A US financial collapse would only exacerbate these negative effects. One potential flashpoint is the controversial Mar-a-Lago Accord, which proposes a radical restructuring of US debt. Under this accord, foreign creditors would be pressured to swap their US Treasury bonds for ultra-long-term bonds with little to no interest. This move, seen by many as a blatant attempt to shift the burden of US economic woes onto other nations, could trigger a global backlash. Countries, already grappling with the fallout of a US financial collapse, might retaliate with their own protectionist measures, further fragmenting the global economy. The weaponization of the US dollar is another alarming possibility. In the aftermath of a financial collapse, the US government might resort to using its control over the dollar to its advantage. This could involve restricting access to dollars for certain countries, effectively cutting them off from international finance and trade. Such a move would be a drastic escalation of economic warfare, with the potential to permanently fracture the global financial system. The proposed Mar-a-Lago Accord, shrouded in controversy and uncertainty, represents a potential trigger for global financial chaos. This accord, rumored to have been hatched during a clandestine meeting of global elites, aims to address the soaring US national debt through a highly unconventional and potentially disastrous approach. The core idea is to force foreign holders of US Treasury bonds, including countries like China and Japan, to accept a raw deal, swapping their existing bonds for new ones with significantly longer maturities and drastically reduced interest rates. Proponents of the accord argue that it's a necessary evil, a desperate measure to avert a complete US financial meltdown. They claim that by reducing the interest payments on its debt, the US government would have more breathing room to stabilize its finances and stimulate the economy. However, critics view the accord as a reckless gamble, a dangerous game of financial chicken with potentially catastrophic consequences for the global economy. The accord's reliance on coercion is particularly troubling. Leaked documents suggest that the US government is prepared to use a combination of carrots and sticks to strong-arm countries into accepting the deal. The carrots include promises of increased trade and investment, while the sticks involve threats of tariffs, sanctions, and even the withdrawal of military support from key allies. Such coercive tactics, if employed, would shatter trust in the US financial system and send shockwaves through the global economy. The 2008 financial crisis, a stark reminder of the interconnectedness and fragility of the global financial system, serves as a cautionary tale. Triggered by a toxic brew of subprime mortgages, lax lending standards, and complex financial instruments, the crisis rapidly spiraled out of control, leading to the collapse of major financial institutions, a global recession, and widespread economic hardship. While the crisis prompted calls for reform and a tightening of regulations, The question remains, have we learned enough to prevent a repeat performance? One of the key lessons of 2008 was the danger of excessive leverage and risk-taking in the financial system. When banks and other financial institutions take on too much debt and engage in risky lending practices, they become highly vulnerable to shocks. The rapid unraveling of the subprime mortgage market in 2008 exposed this vulnerability, as banks that had loaded up on these toxic assets found themselves on the brink of collapse. Another crucial lesson was the need for greater transparency and accountability in the financial system. The complex web of derivatives and other financial instruments that played a central role in the crisis were often poorly understood, even by those who traded them. This lack of transparency made it difficult to assess risk and allowed problems to fester until they became too big to ignore. Section 5. Regulatory tightrope, navigating liquidity and stability. In the aftermath of the 2008 financial crisis, regulators around the world scrambled to strengthen the global financial system and prevent a repeat of the near meltdown. A flurry of new regulations, including the Dodd-Frank Act in the US and Basel III international standards, aimed to rein in excessive risk-taking, enhance capital requirements for banks, and improve oversight of financial institutions. While these measures have undoubtedly made the financial system more resilient, they have also introduced new challenges. One of the most significant impacts of post-crisis regulations has been on market liquidity, particularly in the corporate bond market. Liquidity refers to the ease with which assets can be bought or sold without causing significant price movements. Regulations that increased capital requirements for banks, while intended to bolster their stability, have also made it more expensive for them to hold large inventories of corporate bonds. This decline in dealer inventories has raised concerns about market liquidity. In times of stress, when investors rush to sell assets, a lack of liquidity can exacerbate price declines and lead to a freeze in credit markets. This, in turn, can amplify economic downturns and make it more difficult for businesses to access the financing they need to operate. Section 6. The Global Contagion. How a U.S. Crisis Infects the World. The interconnectedness of the global financial system means that a U.S. financial collapse would be felt far beyond its borders. The shockwaves would ripple through the global economy, impacting trade, investment, and financial markets worldwide. Countries with close economic ties to the U.S., particularly those heavily reliant on exports to the U.S. market, would be hit hardest. But even economies with less direct exposure would experience significant fallout. One of the most immediate impacts would be on global trade. The U.S. is the world's largest economy and a major trading partner for countries around the globe. A financial collapse would send U.S. consumer demand plummeting, leading to a sharp decline in imports. This would be a major blow to export-oriented economies that rely on the U.S. market for their goods and services. Global investment flows would also be disrupted. A U.S. financial collapse would trigger a flight to safety, as investors dump risky assets and seek refuge in safe haven currencies like the Swiss franc and Japanese yen. This would lead to a sharp decline in investment in emerging markets and other perceived risky destinations. Section 7. Echoes of 2008, From Housing Bubble to Global Meltdown. The 2008 financial crisis, etched into our collective memory as a period of economic turmoil and uncertainty, offers valuable lessons about the potential consequences of a U.S. financial collapse. While the exact triggers of a future crisis may differ, the underlying dynamics of interconnectedness, leverage, and risk appetite bear striking resemblance. Understanding the causes and consequences of the 2008 crisis can provide insights into how a future collapse might unfold and the potential global ramifications. At the heart of the 2008 crisis lay a perfect storm of factors, including a housing bubble fueled by lax lending standards and the proliferation of subprime mortgages. These mortgages, often granted to borrowers with poor credit histories and low credit scores, were packaged into complex financial instruments known as mortgage-backed securities and sold to investors around the world. As housing prices soared, so too did the value of these securities, creating a sense of complacency and fueling further risk-taking. When the housing bubble burst and prices began to plummet, the value of mortgage-backed securities collapsed, triggering a chain reaction throughout the financial system. Banks and other financial institutions that had heavily invested in these securities found themselves facing massive losses, leading to a credit crunch and a freeze in lending markets. Section 8. The Interconnected World, a Financial Domino Effect. The 2008 financial crisis starkly demonstrated the interconnected nature of the global financial system. What began as a localized problem in the U.S. housing market quickly morphed into a global crisis, highlighting the speed and ferocity with which financial shocks can reverberate across borders. This interconnectedness, while fostering global trade and investment, also creates vulnerabilities, as problems in one part of the system can rapidly cascade and amplify, infecting the entire network. The interconnectedness stems from various factors, including the globalization of financial markets, the rise of complex financial instruments, and the increasing integration of global supply chains. The globalization of financial markets has led to a surge in cross-border capital flows as investors seek higher returns and diversify their portfolios. This interconnectedness, while generally beneficial for global growth and development, also creates channels for rapid contagion. When a shock hits one part of the system, investors often react by pulling back from risky assets across the board, regardless of their location. This can lead to a sudden stop in capital flows to emerging markets and other vulnerable economies, exacerbating their economic woes. Section 9. Charting a course preventing the next global crisis. Preventing future financial crises requires a multifaceted approach that addresses the root causes of instability and strengthens the resilience of the global financial system. While the 2008 crisis exposed weaknesses in regulation and oversight, it also highlighted the importance of international cooperation and the need for a shared commitment to financial stability. Strengthening financial regulation and oversight is crucial. This includes ensuring that banks and other financial institutions have adequate capital reserves to withstand losses, tightening lending standards to prevent excessive risk-taking, and improving transparency in financial markets to allow for better risk assessment. International cooperation is essential for addressing the global nature of financial risks. This includes coordinating regulatory efforts, sharing information and best practices, and providing financial assistance to countries facing economic distress. Promoting sustainable economic growth is key to long-term financial stability. This involves addressing income inequality, investing in education and infrastructure, and fostering innovation and job creation.